Have you ever stared up at one of those massive, sleek apartment complexes and thought, okay, how on earth do you buy a $10 million building with only, say, 100 grand? It feels like a math equation that just absolutely does not compute, right? I mean, traditional real estate investing often feels locked behind this giant paywall. And that paywall? It's steep. We're talking $10 million. For most of us, coming up with that kind of capital to buy commercial real estate on our own is literally impossible. It completely shuts us out of the wealth-building potential of those large-scale assets. But what if there was a structural workaround? A way to totally bypass that multi-million-dollar problem? Well, welcome to this explainer. Today, we're unlocking the secret behind that exact workaround, real estate syndication. This is the brilliant financial solution that completely shatters that massive capital barrier, making large-scale property ownership accessible to regular investors like us.
Here's our quick roadmap for today. We'll cover the real estate barrier in pooling money, general versus limited partners, the waterfall structure, weighing risks and rewards, and then a quick conclusion.
All right, let's jump right into Section 1, the real estate barrier and pooling money. So how do we actually overcome that huge cost? We use a concept called syndication. Syndication is simply pooling the financial resources of multiple investors to buy, develop, or operate a property that would just be way too expensive to tackle alone. Think of it like, well, basically crowdfunding for professional real estate. Instead of buying one tiny rental house all by yourself, you team up with a group of others to buy an entire apartment community. And when you pool your money like that, you unlock some amazing immediate benefits. We're talking passive income generation, access to those institutional-grade assets we mentioned, and serious tax advantages like depreciation that pass right through to you. But honestly, the absolute best part? Professional management. You get all the perks of real estate ownership without the late-night headaches. Literally, no one is calling you at 3 a.m. because a pipe burst. Which leads us perfectly into Section 2, general versus limited partners. To make this whole thing work legally and operationally, syndications divide everyone into two very distinct roles. On one side, you have the general partner, or the GP. These guys put in the sweat equity, they source the deal, secure the financing, run the day-to-day operations, and carry the liability. On the flip side, you have the limited partner, the LP. That's you. Your role is purely financial. You bring the capital, you stay completely passive, and your liability is strictly limited to exactly what you invested. To put it as simply as possible, the general partner is the active manager and the limited partner is the passive investor. You are basically just buying a slice of the pie. The GP acts as the bridge, connecting your money to the physical bricks and mortar, handling all the heavy lifting so you don't have to. Okay, moving right along to Section 3, explaining the waterfall structure. This is where it gets really interesting. This is the financial engine of the deal. Since we have active managers and passive investors, we need a genuinely fair way to divide up the profits. We do this using a waterfall structure. This is a tiered hierarchy of profit distribution. Imagine cash flowing into sequential pools or buckets. One bucket literally has to fill up to the very brim before the cash can flow or cascade, like a waterfall, into the next tier down. It's a very clever model designed to perfectly align the GP's incentives with your returns as an LP. Picture actual buckets catching water. In Step 1, the first bucket is the return of capital. Investors get their initial money back first. Once that overflows, it hits Step 2, the preferred return, which is a target percentage paid out to investors. Now, if the deal is absolutely crushing it, water flows into Step 3, the GP catch-up, where the managers get a cut to catch up to the investors. Finally, any leftover excess goes into Step 4, a shared profit split, often called the promote. Let's zoom in on that second bucket for a second. 8%. This is a super common preferred return. Practically speaking, this means you, as the limited partner, get the first 8% of the profits on your money before the sponsor takes their cut. It's fantastic investor-first protection. It forces the GP to actually perform and clear that 8% hurdle before they get to share in the real upside. And look how the math shifts once that initial 8% hurdle is cleared. Up to that 8% return, the LP gets 100% of the profits. The GP gets zero, nada. But above 8%, the remaining profits are split. In this example, it's 70% to the LPs and 30% to the GP. That 30% is the promote. It's the reward for the GP exceeding expectations and knocking the business plan out of the park. You'll actually see a couple of variations of these payouts in the wild. The two main types are European and American waterfalls.
A European waterfall heavily protects the LPs by withholding that GP promote until the entire fund level return is met, meaning you get your money back across the whole portfolio first. An American waterfall, though, pays the promote deal by deal. That gives the GP faster payouts, sure, but it requires clawback provisions. So if a later deal tanks, the GP might literally have to give some of their early profits back to make you whole. All right, let's head into Section 4, weighing risks and rewards. Because look, while the math and the passive income sound fantastic, no investment is without risk, right? You need to know exactly what you're signing up for. As an LP, you have to be totally comfortable with illiquidity. Your money is tied up in a physical building for years. You can't just click a button and sell your shares like a stock. Plus, you have zero control over how the asset is managed or when it's sold. You're entirely dependent on the sponsor's expertise and subject to broader economic market fluctuations. Because you have no operational control, betting on the right jockey is absolutely crucial. This quote hits the nail on the head. The sponsor is the single most important variable in any syndication. Honestly, you could have the best property in the hottest market and a bad operator will still ruin it. You really have to dig in and thoroughly evaluate the general partner's track record and their transparency. To do that, you need a solid due diligence checklist. Always, always read the private placement memorandum, the PPM, and the operating agreement. Ask the hard questions. What is my preferred return? Does the profit split suddenly change at certain hurdles? Are the sponsor fees reasonable? And maybe most importantly, does the GP actually invest their own capital alongside yours? You want to be sure this syndication perfectly aligns with your own financial goals. Which brings us to our final section, the conclusion. Let's wrap up everything we've covered in this explainer and hit those key takeaways. We've seen how syndication totally removes that massive $10 million barrier by pooling capital. We defined the roles, LPs bring the money, GPs bring the sweat equity. We walked through how the waterfall structure aligns everyone's interests by prioritizing your returns first. And crucially, we learned why evaluating the sponsor's track record is the most important job you have. So I'll leave you with this final thought. Are you ready to trade those 3 a.m. leaky roof calls and the everyday headaches of being a landlord for the massive passive potential of real estate syndication? If you understand the structure, you're cool with the illiquidity, and you can find the right sponsor, well, this might just be your key to unlocking institutional-grade wealth. Thanks for joining me on this explainer, and keep learning.